Welcome. This is Accounting with Bennett Tchaikovsky. Our topic today is accounts receivable transactions. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. All rights reserved. Okay, so what we're doing right now is we are going to go take a look at, from our previous chapters, we've gone through and we have recorded receivables. This could be from the sales of goods. This could be also from the sale of services. However, do receivables go bad? And unfortunately, they do. We cannot do everything to prevent an account receivable going bad. There are lots of things we should do prior to accepting a client. And I will save those for another video, because for this video, what we're really going to focus on is the different methods of how we go through and create a Contra asset account, which we call the allowance for doubtful accounts. So there are a few different methods we can use, and the two methods that I cover are the allowance for doubtful accounts, or ADA, based on a percentage of accounts receivable. And I also have an allowance for doubtful accounts based on an aging of accounts receivable. There is also another method, and what we call the income statement approach, where you're taking a percentage of credit sales and then essentially coming up with bad debt expense. But I was at a conference and I spoke with somebody who was a member of the FASB, and they said that method is simply not acceptable. So when we're looking at this, and again, our goal is to show to the reader of our accounts receivable account. So we have accounts receivable, which is on our balance sheet. And what I'm trying to show the reader or the user of the financial statements is what amount do we ultimately expect to collect from how much do we expect to collect from our customers? So to do that, we're going to use something called the allowance for doubtful accounts, or ADA, to give us accounts receivable net. And when we say accounts receivable net, what we're really saying is that this is the amount that we are expecting to be collecting from our customers. So, and again, we'll try to make lives a little bit easier on ourselves. We'll call this AR. And there we go. Okay. So what we're ultimately trying to do is show accounts receivable less our allowance for doubtful accounts is going to be giving us accounts receivable net. So XOS DIR, which I can't use Major League Baseball team, so I'm having fun here, or XDI, had the following receivables related to its operations as of December 31st, 2017. So we have days past due, the accounts receivable balance, the percentage uncollectible, and I went too quickly and I shouldn't have given you that amount. But on a test, you'll see the categories, and then you'll see accounts receivable, then a percentage uncollectible. Now, there's really two different ways when we're looking at the balance sheet approach that we can be handling our accounts receivable. The one way is that you could be given a percentage. You'd say, okay, of the $700,000, 20% is not going to be collectible. Therefore, when we are establishing an allowance for doubtful accounts, we would just take this $700,000, multiply it by a percentage, and that would give us our ending balance in our allowance for doubtful accounts. But when we're using an aging method, what we're really trying to do is to look at this amount of receivables and break it down by category. And why this is going to be helpful is why? Because as we look at receivables, the longer it takes to collect, the more unlikely we are going to be able to collect. So it's very important for us to be looking at receivables in terms of these various different categories. So let's take a look here. So XDI had the following breakdown. And so they had 700,000 of receivables broken down into these different categories. And what we see here is management's estimate in terms of the percentage they believe will be uncollectible. So to come up with our ending balance in the allowance for doubtful accounts, what we need to do is we're going to take the amount of accounts receivable and we're going to multiply that by the percentage uncollectible. So we're saying here that of the days past due of 1 through 30, or that $200,000 balance, 2% is not collectible, or $4,000. Here we had 300,000 times 4%, 40,000 times 10%, and then 60,000 times 25%. And these percentages are not going to come from you. They're going to be coming from management. It's management's estimate in terms of what is not going to be collected. So here, when I add these up, I'm going to get a total of $36,000. So my ending balance and my allowance for doubtful accounts is going to be $36,000. And this is why we take the balance sheet approach. We're looking at this balance of accounts receivable on December 31st, 2017, and we're saying, hey, of these balances right here, this is what's happening, right? This is going to be the percentage uncollectible. So we feel that of this $700,000, $36,000 will not be collectible. So when we go to do the balance sheet, we've kind of, number 4 here, prepare the balance sheet presentation of accounts receivable for, I got to change the name of this. This used to be Astros and 7, which is no longer the case. Prepare the balance sheet presentation for XDI as of December 31st, 2017. We can almost do that immediately because the balance of accounts receivable, the amount is $700,000. The amount we're not expecting to collect is $36,000. So the amount of accounts receivable net, or what I'm actually expecting to collect from the customers, is going to be $664,000. Now, this is a very, very important number, and this is what's showing on our balance sheet. The income statement approach says, oh, let's compute bad debt expense first, and we'll worry about this part later. However, most experts feel that when you're looking at receivables on the balance sheet, you really want to take a balance sheet approach because the income statement approach really disregards that presentation of receivables. So the approach we're doing here, or why we call it a balance sheet approach, is we first go through and compute the ending balance, which we'll really call step 1. The next thing that can happen as we go through and we look at different transactions that can impact the allowance for doubtful accounts is right here. It tells me I have a beginning credit balance of $5,000. So we'll write this beginning credit balance in right here. Be our step 2. Then we have to also see what other things or what other types of items can impact the allowance for doubtful accounts. And what will impact the allowance for doubtful accounts are really 2 different types of items. The first one is going to be a write-off to accounts receivable. What exactly is that? Well, in accrual accounting, we want to go through, and the reason why we use an allowance is we know that once we make a sale, very, very rarely are you going to have 100% collection. There's a lot of preventative things we can do, but at the end of the day, sometimes receivables go bad. even if we're selling to former publicly traded companies like Sears. So what we want to do is when we have a write-off of a receivable, the way that this is going to be handled will always be the same. When I write off a receivable, I'm going to be debiting the allowance for doubtful accounts on 5/1/17, and I'm going to be crediting accounts receivable. Here for 2000. And I want to be really clear to you that don't worry about putting the $700,000 down here. That's not for this class. So again, I don't want you to be worrying about, oh, I've got to receive. No, don't worry about that. This is really just here is to be showing you and illustrating how we're going through and handling different types of functions. So we have here this debit to the allowance for doubtful accounts, credit to accounts receivable. So on 5/1/17, I am debiting the allowance for doubtful accounts, and we'll shrink this down to make it a little bit more visible. And I'm going to be crediting accounts receivable. And we'll also make this a little bit smaller. There we go. And I'm debiting accounts receivable here for 2000, crediting, so I'm debiting the allowance for doubtful accounts for 2000. And then here I am crediting accounts receivable for 2000. When I'm writing off an account, I am telling the reader of my financial statements that I no longer expect to receive it. So therefore, I need to remove it from accounts receivable. So here is to write off account of Mo or Vaughn Mo. Sounds like Venmo. Okay, so that was on May 1st, 2017. Now notice here, this form of journal entry, similar to the ones we've been looking at for sales, this will never change. When I'm writing off an accounts receivable, the form of journal entry or a debit to the allowance for doubtful accounts and a credit to accounts receivable will never change. This is always how I handle this type of transaction. So my next part here is on July 1st, 2017, a $3,000 receivable from Sandoval Panda that had been previously written off was subsequently collected. What does this mean? Well, I wrote off a receivable to the Panda, and later on, he decided to pay me back. Does this happen in real life? The answer is yes. A student shared with me, this is several years ago, but his father ran a business that let out catering trucks. 5 years later, a previous deadbeat customer came back and paid the amount they owed for the truck rental. And they said they paid for religious reasons, which is my favorite type of religion, which means they're going to pay. So over here, when I have an account receivable that is collected that was previously written off, I have a couple things happening. One is I'm going to be receiving cash. So I'm getting cash of $3,000. However, what do I need to do before I'm getting that money in the door? Well, the first thing I need to do is I need to reverse the curse. Does that mean turning XOS, what do we call this? Does that mean changing XOS DER to Red Sox? No, that does not mean reverse the curse, although they have. What this means is that we need to reverse on July 1st the previous journal entry we would have done for Sandoval Panda, which is I'm going to debit accounts receivable for $3,000. And this is for the Panda. So I'm going to be debiting accounts receivable for 3,000. Where am I getting this number from? It says right here for transaction B, a receivable that had been previously written off was subsequently collected. So I am debiting accounts receivable and I'm crediting the allowance for doubtful accounts. And so we'll put this, we'll make our lives a little bit easier. So we're going to have here 3,000 and 7117 for 3,000. So I'm debiting accounts receivable for 3,000. I'm crediting the allowance for doubtful accounts for 3,000. This is what we call reinstating the receivable. So when I collect an account receivable that I previously wrote off, I have to reinstate it first. Then once I do this, then I can go through and collect the cash. So the other part of my entry, as we said here, was I did a debit to cash, but now does this customer owe me this $3,000? And the answer is no. They're finally going through and paying it. So over here, what I'm going to go through and do, and let's come up with a color for these because we love highlights, we love colors. It's so much more fun on the exams. Right? You can't do that on the CPA exam, but you can on my test. Just bring in those highlighters and there we go. So right here, I'm now going to be showing a debit to cash of 3,000. And now I'm going to have a credit to accounts receivable for this $3,000 right here. And this is how we go through and handle a transaction where we reinstate the receivable first, and then what we're doing below is we're collecting the cash. Okay, and we have to go through and use this because I need to actually show before that receivable was taken off my books, but now I'm going through and I'm reinstating it. So my journal entry description will be right here to collect, to record, accounts receivable previously written, so we record cash, or cash received from accounts receivable previously written off. Now, when it comes to journal entry descriptions, this will be up to your instructor, your supervisor, whoever it might be. There's not one way to go through and write it. If you're using McGraw-Hill Connect, or if you're using a similar type of software, most of them have had problems with this because there are so many different ways to write the description. But you do need to make a description. And the reason why is when people are going through and reviewing our work, we need to make sure that they can see where we were coming from when it comes to our transactions. So right here, what I also need to do is, and kind of looking at this transaction, this what I'm highlighting here is the same form of journal entry that we always use to show accounts receivable that are collected that have been previously written off. So is this a good thing to memorize for my test? And the answer is absolutely yes. This highlight here in blue will never change for that transaction. So that takes us to our very last part, which is going through and recording what we call bad debt expense. So to record bad debt expense, what I need to figure out is I've recorded everything into that allowance for doubtful accounts, and I now need to figure out, is my allowance for doubtful accounts balance? Does 5,000 plus 3,000 minus 2,000 equal 36,000? Well, if you believe it does, you probably need a little bit more of that Common Core that you've been getting. But for here, we're going to use some fun math, and we love accounting math because it's much easier. We're going to have here 5,000 plus 3,000 plus X minus 2,000 equals 36,000. Or 6,000 plus X equals 36,000. X is going to equal to 30,000. So when I put 30,000 here, so I'm showing here my final step when I do the balance sheet method as a percentage of accounts receivable based on an aging for my allowance for doubtful accounts. The very last step I do is to be recording bad debt, essentially my 1231 entry, bad debt expense. Okay, so here I'm crediting the allowance for doubtful accounts for 30,000. Why? This amount represents the amount of the bad debt expense. For every credit, I need a debit. And here, my debit is going to be to bad debt expense. And as you know from my previous lectures and my other videos, the way we record expenses is with a debit. And so this is what this is coming from here. So the last step we do when we're doing our allowance for doubtful accounts is right over here to do bad debt expense. We do it only after we have recorded write-offs, we've looked at the beginning balance, we've done everything here. But bad debt expense is the very last step we take. So the journal entry to record bad debt expense never changes. It is going to be here, 12/31/17. I am debiting bad debt expense, and I'm crediting the allowance for doubtful accounts right here for 30,000 and here for 30,000. And we'll highlight these here in yellow. And as I'm looking at my work, I clearly have forgotten to make other highlights. So let's make those right here. And for good measure, let's give the 2,000 a fun color. There we go. Exciting coloring books and accounting. I love it right here. And there we go. All right. So I've done this. I now come down and I essentially say, all right, this is here to record bad debt expense. And not because I like UCLA or my students have such a fun time going there. Be sure to look at my IBC website for great student stories. But this is always going to be the journal entry format to record bad debt expense. And that's going to be a debit to bad debt expense and a credit to the allowance for doubtful accounts. And that's what we're showing right over here. So again, this is the very last part is we're doing the bad debt expense. So when I come here, we determine the ending balance on the allowance for doubtful accounts to be 36,000. How did I do it? I took the amount of the accounts receivable times the percentage uncollectible to get my number. Then over here, I did the journal entries for the write-off. When I'm doing a write-off, I'm debiting I'm debiting the allowance for doubtful accounts. I'm crediting the accounts receivable. And then when I get money back from the Panda, I'm debiting accounts receivable, crediting the allowance for doubtful accounts. And lastly, I look at my allowance for doubtful accounts. When I'm looking at my allowance for doubtful accounts, I need to say to myself, okay, what do I need here to balance my T account? Well, I have 5,003 minus 2 gives 36. That's that amount here was 30,000. So that's how I know I've done this correctly. I can also, once I plug in something, I want to add it up. 5,000 plus 3 plus 30 minus 2 gives me 36,000. So I know I've done that properly. And the balance sheet presentation for XDI can be found right here. And this is very important to the reader because the reader needs to understand if the reader looks at accounts receivable, they're assuming that the company is going to be collecting that money. That's what they're assuming is going to be happening. So by showing this accounts receivable less the allowance for doubtful accounts gives me accounts receivable net, what I'm able to do is to show them that, hey, this is what we're expecting to collect as a company. So I want to thank you again for stopping by here onto the unlisted YouTube channel of Tchaikovsky and stopping by. Please send any comments you have in the comment section below, and thanks for joining.